Hello everyone. In this lesson, we will learn about the determinants of option prices. Here's the outline of today's video, and what we will be doing is to go over each of these factors and see how they impact option prices. Let's begin with the stock price. So we are talking about the price of the stock underlying the option contract, and we will look at separately to call options and put options. So let's begin with call options. So remember that the call option contract gives us a right to purchase the underlying stock, right? So let's say the strike price is 10, right? So with this contract, I can buy the shares for $10. And let's say the market price is at the moment $5. So with the stock price, the option contract is out of the money because why would I pay $10, which is the exercise price of the option, while I could buy the shares in the market for $5? But let's suppose the share price jumps to 15, okay? Now this contract becomes in the money, right? If I could exercise it now, it has a net payoff of $5 because I can buy the shares at the exercise price, which is 10, and sell them in the market for 15, yielding a payoff of $5. So for call options, an increase in the stock price, so let's say the stock price increases, makes the call option more valuable. So the price of the call option would increase as well because it would become potentially more in the money. Okay. How about the put options? Now we will have the opposite scenario because remember that the put option gives us a right to sell the underlying stock, right? And here is the payoff schedule. Again, this is the exercise price. Let's assume it is the same, a $10 exercise price. Now, if the current price is 5, this put option is currently in the money, has a payoff of 5. Why? Because with the option contract, I have the right to sell the shares for $10 while the market price is only $5. So ultimately, I could buy the shares from the market for 5 and sell them to the option writer for 10, yielding me a profit of $5 per share. But if the share price jumps to 15, this put option becomes out of the money. Why? Because now I'm better off selling the shares in the market for 15 rather than selling them for $10 to the option writer. So here, the increase in the stock price makes the call option less valuable. Put option price or value goes down. Okay. This was the first factor. Now let's move on to the second factor, which is the strike price. Again, let's look at our payoff schedules, starting with the call options. So the strike price is $10 again, let's assume that. And let's fix the stock price as 15. Now we are not going to play around with the stock price. Instead, we will move around the strike price. Okay. So as you can see here, the option is in the money, right? And with the immediate payoff, the immediate exercise would give me a payoff of $5. Let's suppose the exercise price increased from $10 to $12. So the new payoff schedule will move like this, okay? Now, at the same market price as 15, my new option contract is still in the money, but less so, right? The payoff has decreased to $3, which is the difference between 15 and 12. So as you can see here, an increase in the strike price, let's call it K, decreases the call option price, let's call it C. Okay. How about the put options? Let's examine that as well. And as you can already guess, we will again have the opposite scenario. So let's suppose originally the option price is, the exercise price is 10. So again, let's assume that at the moment, the stock price is fixed at $15. And let's suppose I increase the strike price to 16. Okay, so somewhere here. So now the new option payoff schedule will be that it will be 0, 0, 0, and it will start becoming positive and going up like this. So at a strike price of 16, the new strike price, as you can see, the put option has become now in the money with a payoff of $1. Okay. So at the original strike price of 10, the payoff when the when the stock price was 15 was 0. So here the increase in the strike price have actually increased the put option price. Okay. So originally at this price, the original put option was out of the money, but with the higher strike price, now the new option contract has become in the money. Right, the third factor, the expiry date. So think of it as the point where the option contract ends. Okay, so this might be a month, it might be several months or a year or a week, whatever. Now, let's say that this is the time that is, let's say, sort of left until the expiry. This is the stock price, and it will fluctuate over time. And we have the strike price contractually fixed, right? So let's say again, this is our strike price, and let's say this is again fixed at $10. So let's look at an option expiring in 1 month versus 6 months. And let's suppose we are looking at a call option. And remember from the previous discussion, the call option payoff schedule is something like this. So here we have the stock price. Oops, sorry. We have the stock price, underlying stock price. So until the strike price, no payoff, and then it becomes positive about strike price. So let's say at the start of the contract, the stock price is 8, so we are here. So if this is again 10, at the moment, at the start, we are here at $8. So at the moment, the call option is out of the money. And let's say the option contract, the stock price each day fluctuates. And we are basically getting nearer in time to the expiry of the 1 month option contract. And let's suppose we are just here now. So still at this point, so for example, this could be a price like $9, right? This call option is still out of the money at this moment. And as you can see, there's not a lot of time left until the expiry, right? So there's not too much chance that given the limited number of days that this contract will become in the money, right? But for the 6-month contract, we still have plenty of time. So this contract may expire, the 1-month contract may expire worthless, but the 6-month one might still end up to be in the money, right? So in general, I can say that not necessarily always, but usually this added extra time is valuable, right? And it would increase the value of the option contracts. And finally, we will look at volatility, and we will actually look at similar arguments. But this time, we will fix the time of the expiry, but we will play around with the volatility of the underlying stock. And volatility is all about how much the returns of the stock fluctuate, right? So again, we have the fixed strike price. So let's say again, $10. And let's again say that we are looking at call options. And let's say this is the point where the expiry occurs. So let's say this is 6 months. Okay. Let's compare actually two different stocks, right? And let's say we have an identical option contract. In each case, the contract expires in 6 months, and each case, the strike price is 10. So we have, let's say, stock A and stock B. So let's say B is more volatile than A. Okay. So for example, again, we can start, let's say, a price like $7 for stock A. Because it is less volatile, its prices won't fluctuate a lot over time. Okay. That's the definition of low volatility. So if originally the contract is out of the money, yes, it can turn into in the money, but because the stock is not particularly volatile, we might actually end up here. Okay. So this, let's say this is stock A. Now stock B is more volatile. And this simply means that the swings in the stock prices will be more amplified, both ways, up and down. So let's say B also starts here, but let's say we have movements like this. Now, as you can see, because the volatility is higher, the stock price moves around a lot more, and there is a better chance that this stock B might expire in the money, right? So therefore, in general, an increase in the volatility increases the value of the option contracts. And this is, again, true for both call options and put options. Okay, here is some true-false questions for you to test your learning. And if you go to the video description, you will find a link to the answers of these questions. And that's all I wanted to cover in this tutorial. In the next lesson, we'll be talking about put-call parity, which is an important relationship between put option prices and call option prices, and it is motivated by an arbitrage argument. Until then, take care, and I'll see you in the next video. Bye for now.